All right, thanks everybody for coming. I'm going to go ahead and get into the Q&A. We got prepared questions, and maybe before that, let's get everybody to introduce themselves. So,
I'm Michael Reinhard with Texas Commercial Mortgage.
I'm Josh Welch with Three Pillars Capital.
Colin Marusak with Berkadia Commercial Mortgage.
I'm Johnny King, also with Berkadia.
okay, thanks guys. Our first question is for you from Berkadia. So, what do you guys see as emerging submarkets in Houston that have been overlooked, but you see coming up in the future?
Yeah, so just general Houston knowledge. Houston's a very hot place right now. We'll touch base on that later. Just where we were down on rent in 2015. There's opportunity for investors to really have rent to buy an asset and see improving rent in the upcoming years. So therefore, Houston's been very hot. Occupancy has increased the last couple of years. I like Heights area. Of course, Heights, there's a lot of redevelopment happening right now, and there's a lot of new, older deals that have not had the value add, the renovations. So if your business plan works on that, Heights is a really good place. I think Spring has the Spring and Cypress. There's been a lot of economic growth, a lot of activity in Spring lately, so very active spot right now. Additionally, Cypress is a great area to invest. It's the Axio ranks as the highest effective rate growth this year and forecasted for the next 3 years. And then just personally, I really like Pasadena down south. There's a lot of opportunities down south. There's a lot of assets that sellers or owners have not really seen much activity, and they really are eager to dispose of that asset. And so a potential investor could really come in and create some value in down south in the Pasadena area.
Okay. And Michael, can you give us some background on your business and niche?
Yes, I'm an independent commercial mortgage banker. I was formerly with Imperial Capital Bank, San Diego, and Bank of America, John Hancock Life, and North Houston Bank. I was primarily been in commercial real estate lending, so I was never just a commercial banker, but more of a real estate banker.
Michael, could you speak up?
Oh, just okay. Yeah, can you? Is this on?
It's
Oh, I'm sorry. Okay. So I was primarily a loan officer at the bank, underwriting commercial real estate loans for all types of commercial properties. And back in 2009, the Great Recession, we all got laid off, and so that's when I decided to venture out as a mortgage broker, because I had been an analyst and underwriter for years and years and originating loans, and I did a little short 1 year, a little less than 2 years as a mortgage broker in Dallas. So I thought it was opportunity. I knew I was going to find work in during that 2009, 2010. So in that process, I want to mention real quick that when my time at the bank, I realized that there was a need to show investors how to sell themselves to a banker, because you can look at all the properties you want, but if you can't sell the deal to a banker or to a mortgage company, that's half your transaction right there. So I wrote a book called Commercial Mortgages 101, which is a kind of a beginner's guide for investors that want to transition from residential lending, single-family rental properties and 1 to 4 family to 5+ units, multifamily and larger. And I mean, even my high net worth clients that I did $5, $6, $10 million loans were just very sloppy in their record keeping. They never had a personal financial statement put together, and if it did, I had to redo it for them. So I just felt that there was a need for, and there was nothing out in the bookstores or in the real estate section that met this particular topic of commercial underwriting, and I use multifamily as kind of my case study in the book. So I mean, but this is also for anything other properties, retail and office. So I kind of parlayed this into the brokerage. So I help find your financing in that, and so that's kind of the niche I cater it to, that $1 to $15 million price loan amount.
Okay, thank you. And Josh, can you give us a background on your business experience and niche you're in?
Sure. Yeah, so Josh Welch again from Three Pillars Capital. Mike can probably understand my story a little bit. So I came from a single-family rental background. Like many of you guys, I had a full-time job for a while in engineering, and kind of over time built a single-family portfolio, but then realized very quickly that there's a ceiling if you're trying to scale and turn it into a business that gets reached very quickly. And so I kind of realized, had this epiphany that I really want to go into multifamily in a big way, and the only way to do that is to do it full-time and start liquidating the single-family assets and just transitioning everything over into multifamily. So obviously that takes a lot of work and a lot of effort. So I created Three Pillars Capital a little over a year ago, and we've been acquiring properties in Houston, Class C, ever since, and we're scaling pretty well. And so yeah, that's it.
How long have you been investing in Houston area?
A little over a year.
And for Berkadia, so interest rates look to be rising, and they have been rising. What's your take on this, and how do you think it'll affect the Houston market? And is that going to cause prices to come down or cap rates to rise? What's your outlook?
It's kind of interesting. I mean, even since the last we talked to Josh a week ago, I think the 10-year Treasury is up 15 basis points since that point. So it's definitely an issue. Maybe not an issue, but it's on everybody's radar. What we've seen in the short term is there's so much capital that lenders are trying to push out the door, either from Fannie or Freddie or banks or debt funds or other private lenders, that the spreads that lenders charge over interest rates have come down, and they're being way more aggressive, relatively speaking, from the past 12 months to try to get business and get that money out and generating returns for their investors. So in the short term, the all-in rates are going up, or at least holding steady, but there's going to be a point as the 10-year Treasury and Treasury rates and LIBOR kind of keeps creeping up, that these lenders aren't going to be able to tighten their spreads anymore. They're going to be forced to charge a rate that's higher. And I mean, what happens with cap rates, I'm not sure. I mean, it does seem like they can only go up. So that's kind of what everyone's wondering. So we have lenders in our offices constantly that are just like you guys, trying to figure out how to find business and find deals. They're guys out of New York, Chicago, LA, and they're like, so how can I find somewhere to place $100 million? And we were hoping that you could tell us that. So it's there's some people that are deal starved, but there's a lot of capital.
Okay, thank you. This next one's for you, Michael. What regions are you doing most of your business in?
I primarily work Texas market. I can lend nationwide, but I rarely ever go to California. Actually, a lot of California investors are buying properties in Texas, so they're coming here. But primarily Texas. I do have a Santa Rosa, California client that has ventured from the Dallas-Fort Worth area up to Indianapolis, and he primarily does office buildings, so he's not doing multifamily. But and I just recently closed a loan, $6 million loan for him in the Washington, D.C. area on an office acquisition. He had a 1031. I'm also very experienced in dealing with 1031s. Does anybody know what a 1031 is? It's where you trade up and you have to pay the capital gains tax. So I do quite a few of those in helping the clients buy that next property. So this is what this particular client likes to do, but just pretty much stay in Texas most of the time.
Okay, thank you. And Josh, what parts of town are you focusing in for acquisitions?
Yeah, so we're Houston focused, definitely Houston focused, but particularly within Beltway 8. I know it's kind of a big region, but some areas that we found a lot of traction and deals that kind of fit our radar. The Pasadena areas, Spring, the Heights, kind of those regions, kind of outside of 610. A lot of stuff within 610 is kind of really priced up, so we tend to find a lot of the opportunity for what fits our wheelhouse out, kind of within the Beltway 8.
Okay. And for Johnny and Colin, how much capital did Berkadia originate last year? Kind
Yeah,
of.
so our group as a whole, we work on the Houston office. Berkadia is nationwide. Our Houston office did about 1.7 billion last year through about 200 transactions. This year we're on track for to a little over $1 billion at the end of this quarter. So primarily last year I would say 20% of that was in Houston. This year we're on track, or in Texas in general. This year on track to do about 40% in Texas. So definitely seeing more activity in Texas. Definitely seeing more activity in Houston. We think from an investment standpoint, Houston was very undervalued the last 2 years, especially during oil. But with oil being as high as it is right now, and I think on Monday it was the highest it's been in 3 years. Texas, our Houston market is very appealing. So we're seeing a lot more investors get more active. There's a lot of people are chasing cap rates. More investors are just leaking to Houston compared to last year. So seeing a lot more activity in Houston, and have a lot of investors interested in Houston right now.
Thank you. Michael, can you tell us about some of the more complicated deals you've done, or maybe just one?
Well, yeah, I can tell you one.
Yeah.
This was complicated. It was several years ago. Is anybody familiar with pref equity financing? You got your senior mortgage, and then there's another, what they call a mezzanine loan, which is another fancy word for a second mortgage. Then you have pref equity. This is multifamily deals. Very, very interesting transaction. It was involving a HUD loan that had it was a 221D4. It just means it was HUD. It was a permanent loan, but then they were acquiring it, so they were kind of assuming the loan. But the investor was trying to raise his $2.2 million in equity, and because it took 8 months to get that loan assumption done, all of his investors got impatient and started to walk away. So he came to me. He says, "Well, I got to close this deal." He finally got the HUD commitment. He had to close. I got this loan on April 13th. He had to close this loan by May 2nd. 3 weeks, less than 3 weeks. He goes, "Can you give me, help me raise another 1.6 million?" I said, I'll try. So got a group out of Dallas. We went down to see the property, and they wound up structuring. They gave him, out of the 2.2 million, he had about $500,000 that he could bring, and so it got it down to like 1.6. So this particular pref equity lender structured it where it was a mezzanine loan of 1.4 million, and then they treated the rest of the 200,000. It was $1.6 million commitment as a pref equity. So that usually requires like 10-12% return, and so anyway, they got the deal done in 3 weeks. So I don't want to ramble on too long, but it was I was actually impressed myself. So it was. I mean, because he had $200,000 earnest money all at risk, and if he didn't close, then he could have. The seller would have just said, "We're not waiting anymore."
Hope he sent you a thank you card. That's a good one.
I paid good.
Yeah. Josh, can you tell us about your goals for 2018?
Yeah, so just kind of put it simply, a simple metric. We're getting to 500 units this year. That's our goal. We're about 20% of the way there right now. And as we find a lot of synergies and we make a lot of connections in our network, we're finding that getting to that number is going to be a lot easier towards the latter half of the year than in the beginning in Q2. So that's what our goal is.
And to come back around, Johnny and Colin, can you tell us a little bit about yourselves and your background, how you started at Berkadia?
Yeah, sure. So I graduated from A&M. And I did a real estate finance program there. From there, I went on to work for a DUS license lender, Fannie Freddie lender. I worked there for about 2 years, and then moved to Houston and was at Alliance Residential, which Alliance Residential is the largest Class A developer in the nation. So I was building suburban Class A and core Class A products. I also participated in about $400 million, about 10 different closings of Class A product, and then we got on the acquisition game, so started looking at acquisitions, Class A core assets. Participated in about 3 different acquisitions for about $250 million. From there, I was stuck in a spot where oil went down, and not many investors would want to invest in Houston, so couldn't really find debt for the largest developer at the time. Couldn't find debt in a Houston core asset. Kind of interesting. So wasn't seeing the deal flow that I wanted to, so left to Berkadia, and I've been at Berkadia now for about 10 months. And so at Berkadia, we're helping lenders like yourself from all different sizes. So our investors like yourself, whoever might be, help find different financing solutions, all the way up to the guys trying to buy the inner core Houston. So been at Berkadia now for 8 months, and I'm on the analyst team here in Houston.
Yeah, I've been at Berkadia about 7 months. Went to A&M like Colin did. I got my start selling retail properties in Fort Worth, Texas. I've been in Houston for about 5 years. For the last 4 years, I worked for a small investment partnership. We were looking for opportunistic assets, a little bit of multifamily. We bought some vacant property, we bought a marina, we bought a water wastewater utility business. So I was kind of supporting the principals in the office and underwriting some of these weird opportunistic, transactions and raising equity and getting loans, talking to banks and trying to sell these opportunistic stories. Made the switch to Berkadia to get a little bit more activity, a little bit more volume, work with lots of different clients. So, really what Colin and I try to do, regardless of where interest rates or cap rates go, is work with, like you said, investors that are looking to buy their first deal for $1 million or less, or investors buying their 100th deal for $50 million. Put together a plan for, okay, here's the debt that works for that property, here's the financing that works, here's who we're going to go talk to, and then here's how we can execute. So that's what we like to do, and it's fun.
It is fun, right?
Especially now.
Okay. And Michael, can you give us an idea of kind of how the deals that you work on, how do they break out as far as more traditional financing, non-traditional, preferred equity, mezzanine debt? How, what do you see?
Well, most of my loans are senior mortgages. And like I said, I just helped an investor refinance the entire Lone Star Brewery site in downtown San Antonio. That was I guess you're familiar with the hard money, and that was a hard money deal. That was extremely difficult. But and I very seldom do hard money loans because everybody that calls me wants high leverage and the lowest interest rate and the highest leverage. And hard monies are the opposite, the highest interest rate and the lowest leverage they can get. Now I do, once, and I do multifamily. I've done small. I do as little as $500,000 on a multifamily deal. I did one down in Brownsville or McAllen. I've got little banks where I usually do I've done several Freddie Mac small balance loans, but I do have a lot of banks that are very competitive that'll do these little smaller deals less than $1 million. I always tell my clients, if they're looking for multifamily, stay above $1 million, actually $1,250,000, because 80% is $1 million. So, because anything less than that, it's really tough. And I get calls all the time. You got to try to stay above $1 million, because even commercial, and I'm going to mean by commercial, retail, office, industrial, it's hard to find a lender competitive loan less than $1 million. So, just take away anything. Just try to stay. I know it's a lot of money, but. And then pref equity, mezzanine, I do one or two deals a year like that. I'm actually working on one in an office building in Los Colinas, Dallas. It's a guy came to me, he's looking for $8 million in pref equity on a $22 million acquisition. 72% occupied. He has this plan to reposition it. So, and he's got this great bank in Fort Worth that I was shocked that they're going to do it for 4.25%. That's like amazing on the senior mortgage. So, but I'm glad to take the $8 million loan, so I'm not complaining there. So another thing about mezzanine, difference between mezzanine and pref, the primary thing is mezzanine loans a little more complex. They require an intercreditor agreement, or what they call a tri-party agreement with the senior mortgage lender. And they're usually capped out at about 80%. So your total financing, if you want to borrow first mortgage, second mortgage, the mezzanine lender usually says, we'll go up to 80, 85, and typically it's 80. Where pref equity, they can go up to 95, and usually 90, but they'll actually go 90% of your total equity. So, and that's what this situation in Dallas is. His total equity requirement's $9 million. So he wants somebody to come in and give him 90% of that, and he's gonna only put 10%. So, and the pref equity too is, what's other comments about it? It's usually the mezzanine rates are a little bit lower, but lower leverage, where the prefs is higher leverage and higher rate, so.
Okay. Thank you. Josh, so when you're looking at a multifamily deal, what are some of the common traits you might notice that tell you it's mismanaged, there might be a value add opportunity?
Yeah, that's a good question. So like I said before, we specialize in the Class C value add space, and with that, we're also in the 50 to 100 unit range, and in that range, it's small enough where you can find a lot of single owners, maybe owned by a family, and it's too small for institutions. So what happens is over time, either let's say there's an issue in the family, there's strife, and they say screw it, I just want to, and then nobody takes care of the property. Well, over time, you can get a lot of mismanagement, a lot of operational inefficiencies, expenses will creep up, just because people take advantage of that situation. It happens all the time. So we see constantly, T12s with expense items where, this is things have just ballooned out of control. So that's a common thing that we see. Another thing that you guys can probably all relate to is just rents that are way under market. And again, that goes back to just kind of eye off the ball, not having an active approach, not having a professional run it like a business, like it should be. And so, you identify one of those properties, and it's a gold mine, right? We love those kinds of properties. Some people say, wow, that's a big headache. You got all this work you have to do. That's how you add your value. So those are a lot of the common traits that we see.
Okay. And for Johnny and Colin, so you guys mentioned that you're growing a lot in Texas as far as bringing in money. So what do you guys see changing as you grow? The property type or size?
I think the lending options are because of rates and because of cap rates and prices being so high that we're having to get a little bit more creative on the lending side. So Freddie and Fannie are the most, if you're going to go buy a stabilized, multifamily value add property, or even close to Class A property, economically they've been the best option and the most competitive, but prices are getting so high, and other lenders who are trying to get capital out the door are getting so aggressive with their rates and what they can do and how much leverage they can offer, that Freddie and Fannie are losing a lot of deals to debt funds, which are privately sourced lenders that have a lot of capital, and that capital is coming from people that may have at one point tried to buy real estate, but I can't afford to buy something that's going to give me a 5% return, so I'll go lend my money on a on a less risky, more stable basis. So we're seeing a lot more options where we have to go to bridge lenders, a little bit of bank recourse here and there. But what's interesting about the debt funds, and there's a lot of them that really like Houston too, they're non-recourse, and they'll lend up to 75%, 80% loan to value, and you're paying a little bit more in rate, but I haven't seen they're coming. It's oddly enough that their spreads are coming down, so they can try to win more deals. So it's kind of an interesting time, but deals are getting financed. But if you see an opportunity that maybe it's a 70-80% occupied property, there is definitely someone out there that would lend pretty aggressively to get you to a point where you can get it stabilized, and then you could sell it or refinance it with an agency.
That's great.
So we're seeing that a lot.
That's great. Josh, as someone who's leading the group actively buying property, what are some of the challenges you had on your first few deals?
Yeah, it's another great question. Well, obviously anybody starting out, your story and your track record is going to be a huge barrier, right? Nobody wants to be, let's face it, nobody wants to be the first investor. Everybody wants to be the first second. So, overcoming that hurdle and showing that, you got a couple deals under your belt, you've got a history of, returning distributions to partners, returning capital, exiting a deal. Those are all very important things that, okay, once you've done it, then all of a sudden you can say, look, I did this, this, and this. This is why you should, partner with me on this deal. So that's definitely a challenge on the first few. And the second thing is also the types of properties that we're focused on, at least for right now, is there is so much competition because the barrier of entry on that purchase price is low enough where a lot of people can just throw offers out there and waste a lot of time, to be frank, with a lot of brokers, a lot of lenders. Hey, look at this file, underwrite it for me, tell me what you think. So you have to make yourself shine through all the tire kickers in a lot of those deals, and so that's another struggle to really make your offer stand out amongst a lot of the people who, for the lack of a better word, are wasting time, right?
Yeah, that's a good answer. So this next question is for John and Colin. So you guys work with several different types of lending options, recourse, non-recourse, and so of course the most sought after debt is non-recourse debt, because it's secured by the property. But the best known option is Freddie Franny. You guys have talked about that. Those could be difficult for newer, less experienced investors. What other structures are out there for people in that position?
Kind of goes with my answer to the last question. There just are aggressive lenders, and it's kind of hard to know where they are and who they are, and it's easy to call a bank and kind of get that typical, maybe 5-year fixed rate loan and with recourse, and but as institutional and very active buyers kind of work their way down to Class B and Class C properties, the debt fund lenders and Fannie and Freddie are paying more attention in the Class B and C space. So that's kind of who we work with a lot. And really the thing about Fannie and Freddie, it's not that they like to work with first-time borrowers if they believe the story and they like the area and they like the business plan. I mean, there is generally time is the biggest hurdle for a first-time borrower when it comes to working with the agencies. But they offer small balance programs that are a little bit more lenient in terms of net worth requirements, liquidity requirements. But they want to get money out the door just like everybody else, and so they're having to look for these $2 to $5 million multifamily properties, and that's what they want. I mean, they're there so they can provide affordable housing for people all across the country, and yields are cap rates are going to be where they are, and they've got to find a way to finance those. Yeah.
Josh, can you tell us about how you structure deal financing?
Yeah, so it's a lot of it's deal by deal as far as the debt is concerned. So, our first few deals we did a traditional bank loan, which is a 75 loan to cost. If you can find an 80% traditional bank loan to cost, let me know. I want to call the guy, because it's like finding a 4-leaf clover if it's not agency debt. So that's how we did a lot of our first deals. As far as the equity is concerned, we bring on equity partners, and we structure our returns as based on the preferred return model, if you guys are familiar with that. So basically, just to kind of sum it up, you have a hurdle rate, between 8 and 10%, and once that's surpassed on the cash flow distributions, then whatever's left over from cash flow is then paid out to investors with some type of a ratio, right? The general partnership and then the equity partners. So that's how it is. Other deals, if it makes sense, we go after the non-recourse agency options at 80% loan to value. But again, it really does depend on the deal.
Yeah. And so last question here, it goes to John and Colin. And so what's your outlook on supply over the next year, over the next few years for, I guess, both the local Houston market and bigger picture, if you want to touch that?
Yeah, sure.
And I got a follow-up. So
yeah, cool.
Go
So
ahead.
just supply-wise, Houston, of course, 2012, 2013, 2014 were the largest supply years for Class A development that we've pretty much ever had. We had upwards of 22,000 units come online last year versus now this year we're at 7,000 this year, right? So great optimistic. So supply has really dwindled up. New construction's very slow right now in Houston. We had a lot of institutional capital float to Houston when oil was very high in 2012, 2013. So it was very easy to get a deal done. Land prices are at the lowest they had been. So it was a very development-centered outlook. And oil crashed and brought demand down. So since then, we're at 7,000 units this year, and it's going to continue to dwindle, just with construction loans being the hardest loan for a lender to finance. There's not many options for financing for new construction. So it's great optimistic for the B and C space, because as new supply dwindles down, the B and C space really becomes Class A start competing against each other with large concessions. Occupancy, they're trying to push occupancy and rents as much as possible, so stuff flows down to B and C. So we're really optimistic from an investment standpoint, where a lot of guys are going to be coming in and trying to acquire. They're searching yields. They want making returns work, just because there's so much demand out there. What we've touched base, and from that standpoint, that's the same economically, or I guess global or nationally. We're not seeing many develop. It's very hard to get a deal done in the Northeast. You cannot get a deal done in California. There's no new supply in California. So Texas was at the time where institutional capital was flocking, and that's really slowed down. So Dallas, for example, Dallas and Austin, they had huge supply hit in the last 2 years, and the market fundamentals have really decreased just because large supply, rents are very cheap for Class A, brand new product. And so same issue we're running in Houston, where guys are, you can't place capital new deals in Houston or in Dallas and Austin, so therefore Houston's very appealing for a lot of new buyers.
Okay, and you kind of answered the follow-up question already, which is how does this impact Class C properties in Houston? And
yeah, I mean, just same. It's market fundamentals. When the Class A community gets very tight, as occupancy increases, as rents increase, then a lot of renters have to look at B and C options. So not only are B and C options always follow workforce housing, but they get more popular with guys who are younger professionals, because they don't want to move in the Class A spot. So if you think logically, as Class A tightens here in Houston, B and C property is going to be very hot. And then, of course, it's very hard to get a deal done in say, a new supply wise and down south, right? Pasadena is very restrictive. A large developer is going to look at employment, and no one's comfortable with oil where it is right now, just because we're just now hitting a threshold of positive gains in oil. So a large institutional buyer is not going to go develop down south. So the B and C space is really good down south, because oil's at an all-time high. There's jobs, there's job growth, there's oil companies investing again. There's not only oil, but there's plastic industry, there's transportation industry. So down south, you're not going to get new supply. Same story up north. A lot of developers, there was 7,000 units that came online in the last 2 years in spring. You can't get a site under control. There's no available land. There's really no new supply that's going to come online. So again, as market tightens up north, then it's going to dwindle down to the Class B and C space.
all right. So that rounds out our questions. Let's thank our panelists here. And we've got one other special announcement to make, a surprise extra here. The Houston Investors Association would like to present our award for Asset Manager of the Year, and that's for the Houston market. And so, the winner of this award is Josh. So, Josh, welcome.
Have to give a speech now for this?
Congratulations.
Appreciate it. Thanks. Thank you for the opportunity to be here, and it's great kind of telling our story. And I'm glad that the Houston Multifamily Conference can recognize people like us putting a lot of hard work to get going in this business. So thanks.